Markets just moments ago announcing that they will be releasing those results of the bank stress tests in just a few moments, almost 2 days ahead of schedule. Joining us now in this breaking news is Todd Schoenberger. He's the managing director of Land Colt Trading, and also John Brynjolfsson. He's the managing director of the Armored Wolf Hedge Fund. For joining us here on Street Smart. And John, let me ask you first. I mean, what do you make of the Fed has been pushed, it seems as if pushed into releasing these results early?
Well, I think the Fed realized that they had the opportunity to get the news out earlier and quicker. They didn't have a lot of difficult negotiations with the bank CEOs that they've been working with. And so this is a bullish news to the extent that we haven't gotten the news yet, but it's going to be released early.
So do you buy the banks here, John?
Well, we were short the XLF, which is the ETF that covers the largest banks, and we were long the S&P, and we've reduced that short. We wanted to buy back some of that short because it doesn't look like you want to be excessively short the banks here. But one of the reasons to have some of that position on and have some of the puts on is that we are in potentially a very volatile market over the coming weeks and months.
Todd, let me bring you in on this. I mean, are we getting ahead of ourselves here with the banks? You're seeing this rally right now. You saw this rally ahead of the but could these stocks just end up falling and going deeper into the red as they did last year after these results were out?
Right. Well, remember, though, what you want is you need this participation from the banks. So when you start talking about bulge bracket banks, this actually is a big bullish sign. It's been pulled up 48 hours. I guess chairman and probably figured that, look, they're not coming out with any further accommodation. Nothing that argument. So why not bring out this good news now, let the stocks rise, and then obviously maybe the banks might actually do something. I mean, we've been talking about stock buybacks and dividends, but maybe they'd actually start lending again, and that's what we really need.
But yesterday, as it relates to banks, we were concerned about real estate and declining trading volumes. Is that now erased? It's not a concern anymore?
Well, I'm not so sure. I mean, remember, though, the Fed, that does nothing for real estate right now, because if you're a would-be buyer, why would you buy it cheaper from here? So unless there's going to be a definitive deadline actually raising rates and some type of tightening policy, which we haven't heard yet, but once that happens, that would be a great time to actually get back into real estate.
Hey, Todd, you just heard John talking about his position on the S&P, but he shorts some of the banks. He's covering some of that, but he's still staying a little bit. What's your trade right now in the banks?
Well, look, when you start thinking of the bulge bracket banks, I performed well. We have to give them credit. However, there is that potential bullseye, the time bombs of debt that we have to worry about in Europe. I mean, we talk about the pig countries. You have $1.5 trillion of debt there, but our biggest banks here in the U.S. hold $500 billion of that debt.
She's got it.
So then I got to look at the regional banks. I love the regional bank names right now.
Okay, and we're getting a statement from Morgan Stanley, guys. They released a statement on their stress test, and they said that they received, quote, no objection from the Federal Reserve in terms of dividend payments. They said that they had no objection to their 2012 capital plan, and that they also received no objection to the potential buy of added 14% of Smith Barney shares. So again, the Morgan Stanley saying that the Fed does not object to dividend payments. So as expected, Morgan Stanley has passed the stress test as well. But we're not getting any more news, though, or any additional news, John, and I'll ask you this, of buybacks or dividend payments. And you wonder why, if these banks seem to be passing these tests.
Well, one of the things we know is that these banks do have a lot of cash on their balance sheets. Now, the question of what kind of capital they have, of course, that's a longer-term question, an ephemeral question. But the reality is that there's cash on the balance sheets. Banks like J.P. Morgan have announced that they're going to increase their dividends and do stock buybacks. So not surprisingly, we've seen a huge rally in these money center banks.
All right, guys, I think we have some more news this time on BB&T Bank. I'm pulling it up, so bear with me as I try to get to the headlines. It says the Fed did not plan to redeem $3.2 billion in preferred securities, nor did the Fed object to any other of its capital requests. It looks like it will increase its dividend 25% to 20 cents. So we now have 4 banks that have made announcements that were not expected until tomorrow, and it looks like 3 of them are going to be upping, or 2 of them are going to be upping their dividends.
It's interesting. It raises the point that that Paul Miller was making earlier, and that you were talking about, Stephanie, which is, were these tests too easy? I mean, you've got banks that are basically all that we have so far passing them, and what does that mean? I mean, do these tests need to be, if we see one objection, let's say, does that make these tests more?
They've gotten a lot of criticism in the past, and I know it's the European regulators, but last year in June, the European regulators had Dexia pass with flying colors. 3 months later, they were in deep water and needed to be bailed out again because of their Greece positions. And this time, regulators were so concerned about not being viewed as a rubber stamp. But Paul Miller just said these tests are designed for the banks to pass. So it doesn't exactly add up here.
So, John, is that why you're still short some of the banks via the XLF?
Well, one of the things, we're short XLF because we're concerned about the event risk or the kind of disorderly type of situation. In other words, it's a tail risk hedge. Now, I think a very instructive lesson is what happened in Europe back in November and December. They did their LTROs, and then they added onto it this February. But those LTROs, we all know, were not really adding to bank capital. What they created liquidity, they created flexibility, and it's that liquidity and flexibility now extended to the U.S. market, and you can't fight that tape.
I got to ask you another one, John. When you were at PIMCO, you ran the world's largest TIPS fund, Treasury Inflation-Protected Securities. If I look at the 10-year, that has been, over the past 6 months, very consistently trading between 185 and about 215. Right now, it's 212. Is it getting to the point 10 years of buy now, or are we talking about a breakout maybe because of this news?
I would not be a buyer of the 10-year. I'm a seller of the 10-year. We've been short the 10-year. We've obviously profited on that position nicely. What's happened is we've had strong employment reports. We had an extremely strong auto sales. We have the Vegas Strip seeing a 29% increase year over year on traffic on the Vegas Strip. So there's signs of some recovery going on. The Fed, meanwhile, is taking QE off the table, and that is what's pressuring up the 10-year yield. But that 10-year yield, normalized for the current inflation rates, could be 50 or 100 basis points higher easily.
Todd, let me ask you this then. In getting back to the point of it seems as if so far the banks that have announced they've all passed, and you basically wouldn't want to announce unless you did pass. Are these tests, as Paul Miller was saying, designed to have these banks? Are they going to hold credibility in the markets as we move forward?
Yeah, I'm not so sure about that. I mean, look, they're talking about a doomsday criteria scenario, first of all. But number two, why wouldn't these banks have passed? I mean, their balance sheets are quite healthy right now. They have an enormous amount of cash, and now they have the ability to actually increase those dividends, create shareholder value. It's wonderful for stocks, obviously. But I'm not entirely sure these were the easiest tests to pass. Now, now we have to see what's going to happen down the road. But again, this isn't going to improve lending standards. It's not going to actually have the banks and incentivize them to go out and start lending, and obviously to individuals, but also to businesses. So a lot of that still remains to be seen, because a bank right now does not want to ever go hand in hand again and ask for another bailout.
It's to Morgan. Many investors in the market had been preparing for a potential Moody's downgrade. Do you think we don't see a downgrade ahead now?
Well, that's a great question. I don't think we will. I mean, look, if you just look at the macro data, obviously from the bank today, it's tough to think that we will be seeing any type of liability or vulnerability down the stretch from this point forward.
Hey, Todd, what's your trade tomorrow morning on the heels of an up 200 close?
Well, I got to tell you, I like the banks right now. I mean, you'd be a fool not to be one long in the S&P 500, and obviously on the financial side, you should be long. I still love the regional bank story, though. I think there's some great names out there. M&T Bank, Cullen Frost out of Texas. Those are two big winners right now. Obviously, the money center banks are going to do well, obviously, sure.
Todd, thank you. Todd Schoenberger of Land Cult Trading, and also thanks to John Brynjolfsson of Armored Wolf. Thank you, gentlemen, for joining.